Well, it has finally happened. We have hit a very grim milestone. What milestone are we talking about? I think y'all all know. Let's talk about it. Today, Mortgage News Daily, for the first time since July of 2000, we are seeing interest rates, a national average, above 8%. So we are at 8% even today in the Mortgage News Daily average for 30-year fixed rate conforming loans. 1 week ago today, we were at 7.60, so we're up not quite half a point in a week. We are up from 7.28 30 days ago. So we are up 3/4 of a point nearly in the last 30 days. We've talked a lot about what's moving the markets, y'all, but the bottom line is inflation has not gone away. In fact, we have seen some concerning numbers from the producer price index this last week, the consumer price index as well. So that's the wholesale and the retail side, both much stronger than expected this last week. You had a non-farm payroll report, our last report 2 weeks ago, that was much stronger than expected from an employment standpoint. And yesterday we had retail sales that just came in at a blockbuster pace, showing that spending has not slowed. In fact, it ticked up significantly for September in the most recent read. Put all of those things together and you have a lot of ammunition for the Fed to look at when they're pondering a rate hike at either their November or their December meeting. That is the concern, y'all. The market immediately prices in those increasing possibilities. When you look at a consensus of economists, you don't find one on whether we're going to see a hike at the November meeting that's on November 1st or at the mid-December meeting. I am leaning towards the fact that we will see one in November. Majority of economists are saying that we won't see one until December. I actually think the Fed may move a little more quickly. I think they want a surprise for the market at this point. I think they want to see a bit of a jolt in the marketplace to bring bond yields to a level that they think will temper inflation in the long run. As mentioned, y'all, you got to go back to July of 2000 to find interest rates as high as they are right now. Mortgage Bankers Association mortgage applications are at a 28-year low. We are down 21% year over year. So if you compare September of last year with September of this year, we're down almost 21% in mortgage applications. And y'all, we weren't setting the world on fire last year. So it's dramatic slowing in housing activity and in housing borrowing. Here's the thing, y'all. Until we start seeing a sustained trend downward in inflation, until we see significant weakness in job growth, and until we see some tempering of retail sales, don't expect the Fed to be accommodative with regard to interest rates. So this may be something that is clinging with all its might onto the marketplace for the long haul. We certainly hope that that's not the case. But y'all, what's feeding this, and we've talked a lot about this on this call. And by the way, every time I talk about this, these videos get banned on Facebook. So if you want to follow me from a reliable standpoint, go to my YouTube channel. All of those links are on this posting. But when I mentioned that we are spending too much money, Facebook doesn't seem to like that. They view that as political. That should not be a political issue, y'all. In 2019, we nearly doubled federal spending from the 2018 levels. We went from $3.5 trillion in spending to $7 trillion in spending at the start of the COVID pandemic. Since then, we have not given back much of that. We are still spending $6+ trillion a year when we had been reliably at $3.5 trillion to $4 trillion in spending from 2015, 16, 17, 18. All of those were sub $4 trillion annual budgets. We almost doubled that with COVID, and we have not looked back. So when you see this in the speaker situation in the House of Representatives, as you have a few folks that are frankly extremely concerned that we can't continue to run $3 trillion annual deficits without that having a horrific result for us economically. When you have a budget passed that tempers spending by $1 trillion over the next 7 years, when we're running $2.5 to $3 trillion annual deficits, it's frankly a drop in the bucket, y'all. We need more significant reining in of federal spending if we're going to have any hope of getting inflation in check. So sorry for this one to be a little more political than usual, but that's the truth of it. We can't spend $7 trillion and pay back $4 trillion of that in tax revenue without $3 trillion in stimulus driving inflation higher. And that is what we are seeing, and that's why we're going to see interest rates stubbornly high until we see Washington more disciplined in their spending. So wish us all good luck on that one. In any event, I'm here to bring the news, whether it's good or whether it's bad. Grim milestone today. I do think the bond market is a bit oversold at these levels. I would expect to see a bit of relief this next week. We will keep an eye on it for you. If we see something dramatic in either direction, we will bring you the news. Stay blessed. Stay safe. We will talk to you next week.